In this video, I will be talking about the effect of technology on revenues and costs. In the last video, I presented a list of products or services being offered by financial institutions that are built around a strong technological base and increasingly the internet. Technological advances allow a financial institution to offer such product to its customers and potentially to earn higher profits. The investment of resources in many of these products is, however, risky because product innovations may fail to attract sufficient business related to the initial cash outlay and the future costs related to the investments once they are in place. In the terminology of finance, a number of technology-based product innovations may turn out to be negative net present value projects due to uncertainties over revenues and costs and how quickly rivals will copy an innovation. Another factor is agency conflict, in which managers undertake growth-oriented investments to increase an financial institution's size. Such investments may be inconsistent with shareholders' value maximizing objectives. As a result, losses on technological innovations and new technology could weaken a financial institution because scarce capital resources were invested in value decreasing products. Now, about the effect of technology on revenue. One potential benefit of technology is that it allows a financial institution to cross-market both new and existing products to customers. Such joint selling does not require the financial institutions to produce all the services sold within the same branch or financial services outlet. For example, a commercial bank may link up with an insurance company to jointly market each other's loan, credit card, and insurance products. Technology also increases the rate of innovation of new financial products. As we discussed earlier, that many innovations have been introduced through technology, including EFT, POS, debit cards, electronic securities trading, bill paying services, and fund transfer, internet accounting management, and so on. These and future innovations are high growth areas for the modern financial institutions, which strives to attract and retain customers. Finally, we also cannot ignore the issue of service quality and convenience. For example, while ATMs and internet banking may potentially lower financial institutions' operating costs compared to employing full-service tellers, many new customers require even more convenience. However, the inability of machines and digital platforms to address the concerns and questions of some and usually very stable customers may drive such retail customers away. The revenue losses from this group of customers may counteract any cost savings effect, resulting in a need to rethink the appropriate branch banking model. Now, the cost effect. Traditionally, financial institutions have considered the major benefits of technological advances to be on the cost side rather than on the revenue side. After a theoretical look at how technology favorably or unfavorably affects an financial institution's cost, we look at the direct and indirect evidence of technology-based cost savings for financial institutions. In general, technology may favorably affect an financial institution's cost structure by allowing it to exploit either economies of scale or economies of scope. First of all, economies of scale. As financial firms become larger, the potential scale or array of the technology in which they can invest generally expands. As noted earlier, the largest financial institutions make the largest expenditure on technology-related innovation. If enhanced or improved technology lowers an financial institution's average cost of financial services production, larger financial institutions may have economies of scale advantage over smaller financial firms. Economies of scale imply that the unit or average cost of producing financial institution services in aggregate falls as the size of financial institution expands. Thus, non-interest expense per dollar of asset falls and return on assets increases. Sorry. So mathematically, you can see that average cost of a financial institution is the total cost divided by the size of the financial institution measured by assets. So as the economies of scale is earned, this average cost is reduced. This graph shows the relationship between size and average cost. That means the economies of scale. The largest financial institutions, like see in this graph, has the lowest average cost you can see of producing financial services than the relatively smaller financial institutions B and A. This means that at any given price for financial service farm products, Farm C can make a bigger profit than either B or A. Alternatively, Farm C can undercut B and A in price and potentially gain a larger market share. For example, assume that we have two banks, Bank A and Bank B, seeking a merger to gain cost savings arising from overlapping operations. In the framework of there's economies of scale, the Bank A might be operating as average cost ACA, and Bank B might be operating of average cost ACB. If the consolidation of such overlapping activities achieved, that is a cost savings, the merger would lower the average operating cost for the combined bank, let's say Bank C. Whereas the average operating cost is AC. The long-run implication of economies of scale of financial institution sector is that larger and most cost-efficient financial institution will drive out smaller financial institutions, leading to increased large firm dominance and concentration in financial services production. So in this graph, we can see that average cost gradually declines as the size increases. And the implication that I just mentioned in the last slide, that in the long run, economies of scale of financial institution will actually indicate that larger and more cost-efficient firms will drive away the small firms. Such implication is reinforced if time-related operating and technological improvements increasingly benefit larger financial institutions more than smaller financial institutions. For example, satellite technology and supercomputers, in which enormous technological advances are being made, may be available to only largest financial institutions. The effect of improving technology over time, which is biased towards larger projects, is to shift average revenue curve downward over time, but with a larger downward shift for financial institutions. For example, you can see here that this in both the cases, the average cost decline, but if it is a larger firm relatively, the average cost decline will be higher, okay, because you can see that a more downward shift here. This AC1 is a hypothetical average revenue curve prior to cost reducing technological innovations. AC2 reflects, the average cost curve 2 reflects the cost lowering effect of technology of financial institutions of all sizes, but with the greatest benefit accruing to those of the largest size. So the one that are larger, their benefits is larger. As noted earlier, technological investments are risky, and if future revenues do not cover their cost of development, they reduce the value of financial institution and its net worth to the financial institution's owners. On the cost side, large-scale investments may result in excess capacity problems and integration problems, as well as cost overruns and cost control problems. Then small financial institutions will simple and easily manage computer by say computer system or outsourcing information technology services without bearing the fixed cost of installation and maintenance. So the small financial institution will have a cost advantage. In this case, technological investments of large such financial institution may result in higher average cost of financial service production, causing the industry to operate under condition of these economies of scale. So these economies of scale imply that small financial institutions are more cost efficient than large financial institutions, and that in a freely competitive environment for financial services, a small financial institution will prosper. Now, economies of scope, technological improvements or investments in one financial service area may have incidental and synergistic benefits in lowering the cost of producing financial services in other areas. For example, say underwriting, funds management, and brokerage. In particular, the financial institution's ability to generate synergistic cost savings through the joint use of inputs in producing multiple products is called economies of scale, as opposed to economies of scope. I'm sorry, economies of scope as opposed to economies of scale. Technology may allow to financial institutions to jointly use their input resources such as capital and labor to produce a set of financial services at a lower cost than if financial service products were produced independently of one another. Specifically, let's X1 and X2 be two identical financial products. Each is produced by one firm as a specialized producer. That is, firm A produces only X1, no X2, and firm B produces only X2, no X1. The average cost function of these firms are this. Now, economies of scope exist if these firms merge together. For example, here, these firms merge together and jointly produce X1 and X2, resulting these savings. That is, the cost of joint production by the cost synergies is less than the separate and independent production of these services. Now, these economies of scope also may occur instead of economies of scope. This is where financial institution finds costs to be actually higher from joint production of services than if they were produced independently. For example, suppose a financial institution purchases some very specialized information-based technology in case the loan production and processing function. The financial institution could use any excess capacity this system has in other service areas. However, this process could be a relatively inefficient technology for other service areas and could add to the overall cost of production compared to using a specialized technology for each service or product area. Now, let's have an example for economies of scope. A commercial bank has total cost of producing lending services of $120,000 and for a loan volume of $25 million. A specialized investment bank is selling commercial paper for the same customer with a total cost of $12,000 for a $1.5 million issue. So what is the average cost of commercial bank, average cost of investment bank, and what is the total average cost? So you see that the commercial bank is producing a lending services of 120 for a $25 million loan. So the average cost is 0.48%, and the investment bank is selling commercial paper, the cost is $12,000 for $1.5 million. So the average cost is 0.80%. Now, if we combine them, 120 plus 12,000 divided by 25 million and 1.5 million, we see that average cost is 0.50%. So as we combine two different services, the average cost reduces. Now, if we slightly expand this example, is reconsider the example of the commercial and investment banks. Assume that the commercial bank is able to provide both services to the customer. This should enable the bank to reduce the total costs to both services. This is $125,000. So as we find that the new average cost will be 0.47%, and you can see that 0.47% is less than the average cost that we considered, not that we calculated previously, which indicated that the economies of scope exists. So this is the end of our discussion on the effect of technology on revenues and costs. In the next video, which will be the last for this week, we will discuss technology and the payment system and some regulatory issues which relates to the operational risk. Thank you very much.